Hello, hello, everyone. Welcome.
Good evening. Hope everyone's having a lovely day. We've got beautiful weather here in Rochester. Just enjoyed having kind of a lazy weekend with the family and visiting with friends. We went to like the city just gets a bunch of big trucks together in a parking lot, like fire trucks.
Touch a truck.
Touch a truck? Is
Yeah.
that like a national thing?
It's like parents know what it is.
Okay. And then the kids just run around. They're like, big trucks. It's like the magic of childhood right there. And very excited to do our Fund 1 Q1 performance report here. There's a lot to celebrate. And
Yeah. We're joined by baby Abram. For those of you
Mhm.
that maybe don't know, we had a baby on April 6th, and he joins us for our calls now. So let's all cross our fingers that he stays asleep and enjoys just hearing our voices.
And if he does start crying, then we will probably we have someone waiting in the wings just in case.
Yep.
Yep.
Awesome. Well, let's jump in.
Yep.
Can everyone see the PowerPoint presentation, the Black Swan Real Estate Fund 1 slides?
Very good.
Awesome. Very good.
Yep.
Well, let's jump in.
So a little bit about us and a little bit about the fund. I mean, this is really kind of the headline. I mean, is as simple as it gets. We've had over a 100% rate of return so far on the Nicholas and Oliver opportunity. Some of our deals are base hits, which that's kind of what we're aiming for, and then some are home runs, and we kind of aim for base hits that could be home runs, at any given time. And this one has definitely been a home run. I feel like we should, we always have to have the disclaimer that past outcomes do not necessarily indicate future results. And that is particularly the case here for Fund 1, because things are just, this is a far better outcome than we ever possibly could have hoped for. There's a lot of things that have happened that we kind of knew about, like the sale of the most valuable apartment building in the history of Minnesota happening a quarter mile away from this asset. We knew that could happen, but we weren't sure it was going to happen. We didn't think it was going to sell for anywhere near that amount of money. Lots of good things have happened. We thought rents would be, we could attain higher rents, and we've blown away those assumptions. So past outcomes are not necessarily indicative of future results, but that this is even possible, I think, is just a testament to the hard work of our team and just our business plan focusing on the long term.
Yeah, another thing we want to make sure we state in terms of a disclaimer is, these are our projections for Q1 of 2022. So with the way we're structuring the fund, we will have a refi event for Nicholas at some point in the future, and then eventually a sale at some point, hopefully decades from now. This is our best guess point in time, and none of these gains have been realized yet in terms of the value. So we do want to make sure we get those disclaimers out here in the beginning. But this is the best analysis that we can come up with, that if we were to say liquidate the fund today, these are the outcomes that we think we could get, and we're pretty excited about them. So we'll do a little bit of a recap of the fund. There's a lot of people that are here that probably are not invested in the fund because we made this public to our network. And then we'll dive into the outcomes of what we're seeing so far in quarter one.
Let's speak to that for a moment. So we're a big fan of Warren Buffett kind of principles, and we love that, like the Warren Buffett, the Berkshire Hathaway shareholder meetings are a festival of capitalism. Like, come check out our latest manufactured homes, and come check out the latest Heinz ketchup. Just a physical sampling of all the things that they invest in.
Yeah, and, we were joking at dinner, like all the kids want to try the ketchup. So it's a way to get families to go to the meetings.
So, when we have 10 funds and, we have $1 billion fund, we hope that this is like a live event, an in-person event. And we're going to have an in-person event here this July 15 to 17. You can go to Meet Black Swan and sign up right now. We're going to go physically tour those assets, like a Berkshire Hathaway shareholders meeting. We've never seen a private equity fund do this kind of update. We don't just have people that are in the fund invited. We have our whole community invited.
And we don't just do it in writing. We're doing it live.
Theoretically, there's probably like some kind of legal liability or something like that. Our attorneys, wince a little bit when we tell them we're going to do live interactive, performance updates and stuff to not just the fund, members, but to everybody. But we just, I mean, radicalized transparency is one of our most important values of our company. And we think this is just fun. Like this is a little bit of a victory lap, you know, so let's share it with everyone and have a lot of fun with it.
Yep. And we have big goals of changing the way private equity is managed.
That's
and
right.
The way to do that is to spread the word and for more and more people to know about how we structure our funds. Because we think they're, you know, some of the best funds in terms of how they're structured and the alignment of interest between us as the general partners and our investors as the limited partners, and aligning interests, and really not even just aligning interests, but really putting the interests of our investors first. Right. We are so subordinate to our investors, and we think that's the way private equity should be done. And we want to get that word out as much as we can. Absolutely.
And this is interactive. Feel free to pepper us with questions here. We've got a couple of folks on the call that will help capture those questions, make sure we get to them as best we can. So this is, don't let this be a dry boardroom slide deck kind of affair. We want this to be as fun as possible. So, yeah. So, you know, high level details of the fund there. Fund one, we targeted 10 million. We ended up raising about 16 million in one webinar, basically. And we could only keep 11 million of that. So, you know, our attorney said you can go, you know, 1 million over basically is like your margin for error. Really simple, straightforward. We call it our lemonade stand model, where, you know, if you were starting a lemonade stand with a friend or maybe your kiddo, you'd say, okay, I'll buy some sugar and buy some lemons, and then you know, whatever money comes in, you know, I need to get my money back, and then we'll split the profits after that. So that's basically how we structure our fund. It's a really simple structure with no fees or waterfalls or splits and pref and catch-up pref and just a million different, you know, almost unintelligible financial engineering. It's a really simple model that anyone can understand what they're getting. And then critically, it targets the long term. So most private equity funds or syndications are targeting, you know, like a 2 to 5 year hold period. We don't think that's a good thing for the investor. We don't think that's a good thing for the community to have these apartment buildings changing hands every few years. We don't think it's a good thing for capitalism. The IRS does not incentivize it. It really penalizes those short-term hold periods. We love to buy assets that we're going to be excited to own decades from now that are in good locations, to do huge renovations on them, to take them from being the least nice house in the block to the nicest house in the block. And then return capital to our investors with a cash out refi. So that's our whole business model in a nutshell. And I think it's something that just intrinsically makes sense to most people when they hear it. And our hope is people, you know, experience the returns and just the spiritual kind of rewarding feelings that go with this style of investing, and say, well, heck, why isn't everyone doing it this way? That's really our goal. We recently toured a really nice community in Minneapolis. It's about 20 years old, so it really should look, you know, new and beautiful, but it's been through multiple owners already. And, you know, there's some units that are 20 years old. There's some that are renovated like 7 years ago, some that were renovated like 3 years ago, and then some that were renovated like 6 months ago. And they still haven't renovated all the units. They can sell it as a value add project. Yeah. And that right there, I wish we had a video or something to show you all, you know, what that does to a community, to a 20-year-old community that should still look very, very new and be very attractive, just looked sort of hobbled together. And one can imagine what that does for the community when ownership and management is changing over and over and over. It's really hard to develop a culture in a building, and cultures in, you know, those small communities are what set the cultures in larger communities. And we really do everything very differently than that. So we hope to hold these buildings for 20 or 25 years. When I was strapping on Abram, I was thinking, you know, maybe we sell Nicholas when he's like 25, right? Like here he is, you know, newborn today. He was in my belly when we raised the capital for this. Every time I look at Nicholas, there's no way I could ever bring myself to sell it. It's such an incredibly handsome asset. Like you look at it, you can't tell if it was built last year or 100 years ago. It's just kind of a timeless beauty in a location where they had to like pick up and move houses to build this building. Could never be built again, could not be built with today's regulations. It's just I don't know if I could ever bring myself to sell or today's costs or today's cost. That's something to think about. So one thing that's really critical about our business model also is fees. So we don't charge any fees, and we'll have a slide on that at the end. But there's about $800,000 in fees that we've waived that you would typically find in like a normal syndication or private equity fund. Like that's a little crazy, right? That, you know, an $11 million fund, there would normally be $800,000. And that's just in this quarter. Yeah. There would still be fees to come as we acquire more, sign on more notes. You know, there's all sorts of
various events that happen where general partners can typically take fees, and we just waive all of those. And we think it's the right thing to do to put the interest of our investors first. And every penny that's generated goes back to our investors before we see a penny of it.
That's right. We've collected some real estate commissions and some property management fees that would normally be paid to other parties through our vertical integration. But that's the only compensation we've collected in the fund. We've realized zero profit from the funds to date, and won't realize any profit from the fund until all capital is returned to our investors. So those are just some really critical kind of distinctions to call attention to about our fund, and one of the reasons why it's performing so well. So without further ado, let's take a look at Nicholas and Oliver here. So we raised 11 million, and we spent 2.3 million on Nicholas and Oliver.
And just for a reminder, maybe for folks who are newer to us and don't understand Nicholas and Oliver, we kind of call them Siamese twins. So Nicholas is on one street and Oliver is on the opposite street, and they're connected in the middle. So if you're driving down one street, you would have really no idea that they're connected together. But when you know the buildings, then you know that it's one building, kind of one Siamese twin building or conjoined twin building. And we cut corners with what we call it, and we just call it the Nicholas, but it's both Nicholas and Oliver apartments, 95 units total.
Yeah, these are architected in a very specific way to conform to the historic look and feel of this neighborhood. So they could have built some sort of monolith tower rising out of a historic community, but they decided to preserve the intellectual, architectural and aesthetic kind of character of the community. If you are kind of driving by quickly without noticing it, you wouldn't even think that there's a 100-unit apartment complex there. It would just look like a couple other buildings in the neighborhood that just blends in seamlessly. So, but yeah, they're Siamese twins. So normally on a purchase of this sort of magnitudes, this was a $23 million purchase. There'd be something in the neighborhood of like a 1% closing cost. So hundreds of thousands of dollars in closing costs. We closed this for about $20,000. So, and just an unbelievably small amount of closing costs, and we did that through basically the lender charged no origination charges or fees whatsoever. A lot of the legal costs typically involved were waived. We were able to mitigate or avoid mortgage registration tax. When you get into this many zeros, those little micro optimizations, they add up to a massive amount of money. Just between closing costs saved on this one deal and our fees, that's over $1 million of pure value that's just added into the fund. And then the other kind of key piece here is we only spent $2.3 million on it. So a typical fund these days would purchase an asset like this with a 70% LTV loan. So that would be $7.5 million down on an asset like this, or the majority of the cash in the fund. In this case, we used less than 25% of the capital in the fund to purchase it, and we did that by getting a really advantageous seller carry. So we assumed the seller's existing loan, and then got the seller to agree to a carry of $9 million with no interest, no payments for the next 7 years. And the note that's in place is at a now favorable 4.5% interest rate as well. So extraordinarily favorable financing on this particular deal that took, 6 months of negotiation and legal, contracts going back and forth to get to an agreement point. But man, this is working out really well.
Yeah. And the reason this is important is that this allows the fund to acquire more real estate overall. So our number one target is payback period. How quickly can we get all of the capital back to investors? And then after that, we're in an infinite rate of return period because no one has any money left in the deal. So we're dividing by 0, which is infinite. But we want the amount of income that the fund's producing to be as high as possible so that when we're sharing that out amongst all of the investors, each investor gets the largest amount possible. And so by only using, let's say 25% of the fund for Nicholas instead of say 75%, that frees up say $5 million to spend on other real estate. And if you figure that we can typically leverage real estate with like an 80% LTV, that could be as much as like 20 or 25 million more in assets that we can acquire by keeping that cash liquid so that we can buy more assets, and then the overall fund is larger. And that's really important because that's the base that generates these returns for say that 20 or 25-year hold period.
Yeah, we'll probably end up with 2 or maybe even 3 times more total assets under management in this fund than a typical private equity fund would, because of the unique capital stack and debt structure that we use. So really advantageous there. If we look at our single family homes, we see that we've spent, a fair amount of capital on single family homes. This number is out of date. This is just a few weeks old. I think we've acquired maybe.
I think we're at like 22 or 24.
Yeah, we've probably gotten 7 since then. We just wrote an offer on 1 right before the webinar.
And when I say acquired, some of those are still under contract. We've paid earnest money, but we haven't closed, but we're getting them into the pipeline. So we're moving with single family homes. It's been a good quarter, and as particularly a good spring.
That's right.
So we kind of held off in January, wanted to see where pricing would land for 2022. And then once we kind of saw how the market was moving, then we've purchased a lot of homes over the last, let's say 60 days or 90 days, and seeing a lot of momentum with lease up and renovations. And it's been a really good time to buy. So, we buy all year long. We've always done that. We live in Rochester, Minnesota, a very cold, snowy climate. So there are reasons to buy all year long. One of the downsides of acquiring in the dead of winter is that it can be a little bit harder to place tenants. And so for various reasons, we didn't necessarily acquire as quickly in January and February, but then we've really been moving quickly now. And the absorption into our portfolio has really been astounding. So our portfolio-wide vacancy is only 1.4%. So essentially, as fast as we can buy these homes, they're getting rented.
Yeah, Q1 was the lowest inventory quarter in history for single-family inventory in the United States, and also for multifamily. So kind of unusual that those data points would coincide like that. Q4 2021 was the busiest quarter in history for multifamily, so that maybe there's a recovery period or something like that. And we're really starting to see that inventory situation improve. So it wasn't even a question of pricing, like there just wasn't anything to write offers on. And we're really excited to see the market start to get towards an equilibrium point. I don't know. The market is, inventory is so low in both single family and multifamily that it's hard to even call anything equilibrium right now, but certainly conditions are improving. So we're very grateful to see that. So we talked a little bit about Nicholas already. I think we've hit a lot of these points here. You don't really need to read too much into the numbers, but if you look at just our rent collections for January, February, and March, just staggering, upward sprint in rent collections. So when we purchased this property, it was, I think of it as kind of the most handsome building in town. There's nicer assets in town, but this is like architecturally, or I don't know, spiritually, it's just like the most handsome asset in town. And that's just not, I don't think that just because it has my name on it. I just think a lot of care was put into the site and the architecture and the execution of the build. And the rents did not reflect that. So there are other assets in town. This is probably like the 5th or 6th nicest building in our community. The other buildings have maybe nicer amenities like a pool or a health club, an indoor golf simulator. And this is a Class A community that doesn't have that same amenity stack. But in-place rents, let's say on a 1-bedroom apartment, were like $1,300 per month on this particular asset. And on those competing assets that were nicer assets because of their amenities, but maybe not as nice in terms of location or architecture, they're like $1,800 a month or $1,700 a month. So there's a huge gap between where this asset was and where the other assets were. And so our calculus was basically, we think we can close that gap. And what's happened is we've kind of raced to close that gap far faster than we ever could have expected. And I would say that we're very much in price discovery right now. We don't even know what a unit is truly worth in this asset because rents are going up so quickly. If someone is, so like there might be a resident who's in place, rents, let's say, had not been increased since they moved in 2015. And so their, rent on a 1-bedroom apartment is like $1,200 per month. It's pretty difficult to escalate rents to, $1,500 or $1,600 per month in a single generation, so to speak. So we're trying to iteratively, bring those rents up to market rate without being overly disruptive to the in-place tenants. And then we are turning over about 40% of the entire building. That's actively happening right now. By the end of probably July, we will have turned over close to 50% of the entire building. So, rebuilding that plane mid-flight, and the insane number of moving parts required for that is difficult to express. We're repainting units, installing LVP, upgrading common area amenities, that sort of thing. And we don't want to instigate vacancy by reaching too high. So maybe a year from now, rents might be even $200 per month higher than they are today. It's just we're very much in price discovery mode right now.
we talk a lot about vertical integration and how it gives us unique advantages. And that certainly has been the case at Nicholas and Oliver. So Nicholas and Oliver was managed by the woman of the family who built Nicholas and Oliver. So their family had owned the land for generations, and then they had a different business that generated the capital that they put into the real estate to build this, and then she decided to manage it. And Nicholas was well managed in that the tenants are all screened, there's leases in place, there's good culture in the building, the appropriate amount of rules that people enjoy living there because it's an orderly, nice community, but not so strict that it's stuffy or people feel like they're being babysat. Rent collections were very strong. She didn't struggle with delinquency, those sorts of things. But it was pretty inefficiently managed. So, like Nick mentioned, some folks had been living there that hadn't had any rent increases in 5 years. Just different things like that, like perhaps not, painting with
marketing, technology.
Marketing was pretty poor. It wasn't on apartments.com, which is a major driver of leads in our area. Perhaps repainting with the original paint color instead of, trying for that newer color palette, just all of those little micro efficiencies. And because we work with our leasing team so closely every single day, we're able to know the exact pulse of this asset and iterate our business plan around that. And we've been able to drive such good outcomes because of that. And then Nick mentioned, a large amount of vacancy, and someone who, even without being skilled in real estate, you might think, well, 40 or 50%, that's a lot. And it is. And a big part of that is this asset is uniquely positioned in the community in walking distance to both of the Mayo Clinic campuses. So there's a hospital campus and an outpatient campus, and it's kind of right in the middle. There's very few housing units in the middle between those two campuses. And so because of that, there's a young professional population in this building of resident physicians, nurses, respiratory techs, PhD scientists, those sorts of things. And so there's a natural amount of higher turnover as people finish their training, get married, move out of the community, those sorts of things. And that allows us to continue with price discovery. And so there's a lot of kind of factors that are coming together that because we are doing the property management, we're able to have a much faster reaction to this data and drive the value of the asset up faster and faster and faster than if we were one step removed from the property management.
Yeah, question that we got, what did the seller have to gain by structuring the deal with no interest, no payments for 7 years? Excellent question. So we believe in win-win deals. And when we purchased this particular property, there was a steep prepayment penalty on the existing loan. So we actually saved them $1.4 million at the closing table by assuming their existing loan, and then they would carry the balance. We still put a down payment down, but not nearly as large as a lender might ordinarily require. So if you calculate kind of the amount of interest that they would hypothetically pay or lose on that amount of money over the next 7 years, if we allowed that continue for 7 years, that would add up to an amount of money not very dissimilar from what they would have had to pay out of pocket today to defeat that prepayment penalty. So we saved the sellers almost $1.5 million by putting together this structure that mitigated that prepayment penalty. Excellent question. All right, so let's talk a little bit about our value add. We've been talking about that a little bit. So yeah, doing new modern gray color schemes here. 20-30% rent growth. So here's a before and after of the original color scheme that looked very good in 2015. And I would say this color scheme actually works particularly well for, this is just a very handsome asset with kind of classical architecture. So more of like a beige, almost mustard kind of wall color, and more of a beige kind of carpet or whatever. But today, gray is in, the gray palette is in. So on the left, you can see one of the classic units there that has the brown yellow tones. And then we rip out all that carpet, keep the premium. They have really beautiful linen ceramic tile throughout much of the unit, which is very unusual in our area. So we have all LVP, so it's all hard surface flooring throughout the whole unit, which also lets us become pet friendly. So they previously prohibited all pets. We are putting in a pet park and putting in all hard surface flooring and being very pet friendly, which allows us to charge a higher base rent and then pet rent on top of that, and then open us up to a whole other market that just wasn't previously available to this building. So kind of all the, classic value add strategies that we implement. I mean, we're going to spend, a healthy 6 figures just on luxury vinyl plank flooring alone. We have our contractors on average are spending a minimum, well, on average, probably 15 hours per unit for turnovers. Repainting every unit, not every unit, but repainting many units, reflooring many units. Every unit's a little bit different. They're 5 or 6 years old and hadn't really seen a refresh in that time. And many of these tenants have been in there since 2015. So the carpet is completely, depreciated in that time. It's just time for a refresh.
Yeah, there's a lot of flexibility that if we need to keep a unit classic because we're able to place a tenant very quickly, or our contractors aren't available, all sorts of things. There's a lot of flexibility because the units aren't, they're not in such a place that they have to be renovated in order to capture market rent. So really it's price discovery of, if we do these renovations, how far can we push rent? How far can we push pet rent? Those sorts of things. And so there's a lot of flexibility in the business plan, which is important as we're going into the summer and labor shortages, material shortages, all of those challenges that are maybe holding up some of our other renovations, like our 100-year-old buildings where we have to renovate a unit. There's no opportunity to have a resident move out and have a new resident on a new lease move in. In this building, we have some flexibility, and that again, just speaking to vertical integration and how valuable that's been for this asset.
Yeah, Suzanne asked, how do you rehab with existing tenants? So we're not renovating the units where the tenants stay. We're renovating those 40% of units where they're turning over. So I'd say we're doing some amount of renovation in pretty much every single unit. It just varies, how much is needed on that particular unit. They're all kind of original finishes from the construction, 6-7 years ago. And then the units where tenants are not turning over, we're not renovating those units at this time. All right. So, right now, if we were to sell this asset, we're thinking we would probably, try to sell it for $26 million. With the current climate in the multifamily market, I mean, it would probably go to multiple offers.
This is where, number one, Nick and I disagree, and we need like a big flashing disclaimer, because I think it's worth like 28 million.
You're probably right.
I think we would start at 26.
So yeah, what I was saying is it would probably go to multiple
but big
offers
disclaimer that these are our projections, and this is with working with brokers at CBRE, because we're acquiring assets, so we know exactly how much they're asking per unit or for certain buildings in town, because we're in the buyer pool, and so that gives us a great deal of insight to the offers that they're soliciting to other potential buyers, and it helps us to hone in on how they would potentially, market this asset. Again, this asset is not being sold. We're not soliciting it for offers or anything like that. We're just always keeping an estimate on what do we think the value would be, because we always want to see that number climb.
Yep. So I think we're being conservative in this estimation. I think the 28 million number is probably more accurate. Red 44 is a building that sold here recently. They got, I think, 17 offers, if I remember correctly. Best and final was 6 offers. Multiple assets have sold in our community recently for well over what the original kind of pricing guidance was. So we know that whenever it does come time to sell this asset, it'll have a line of eager buyers, and we know that the previous owners of this asset, countless institutions have reached out to them about selling, and they just didn't want to sell to some kind of jerk out of town finance type. This was very much a local to local transaction. They're very excited to see it go to another local family, a kind of dynasty family. I think both of our families are well respected in town and, support local charities and schools. And they were just excited to do a business.
And it's the only way that the bank, agreed with that, we assumed the mortgage, there's a bank that we had all worked with for many, many years. But yeah, the closing was really fun. They closed, and then we closed, and then they had forgotten to sign a paper, and our attorney called them and they said, oh, we're at a basketball game for our daughter, so we'll come back in an hour. Just very small town feel, just a good feeling. We know that probably the days of those deals are nearing an end for us as we target bigger and bigger assets, and we're acquiring from other institutions, and this one just felt really good.
And the owners of this building, they actually have a mating pair of black swans. They have like a little hobby farm, and just like the craziest, they have to have like the only black swans in Minnesota or whatever. And so we got a photo of the black swans, and there's this niche where they had a stained glass piece from one of their original properties that was on this parcel before it was moved or demolished, and they took that with them as like a keepsake. we commissioned a painting of their black swans and replaced that, that piece of art with, so it's a beautiful, it's a beautiful,
it's a good story. It feels
Yeah.
good.
yeah, absolutely. So
I want to go back to that slide because I just want to make sure everyone understands the math there. So part of the reason we are able to generate such a high, we'll call it a hypothetical return at this point, is because the denominator is so low. So our basis in this asset is 2.3 million. Let's round up to 2.5 million. Like Nick said, there really weren't that many closing costs or
we've
anything.
spent some on rehab.
And so if we were to sell it today, we would generate about $3 million in profit. And so $3 million divided by, say, 2.5 is how we get over that 100% rate of return in such a short period of time. So that speaks to the importance of having a low denominator. So, our metric is getting to a zero denominator as quickly as possible. And we were able to come into this deal at a much lower denominator than, really any other buyer would have been able to, because like Nick said, they would have had to have brought at least 20 and potentially more like 30% down. But because we were able to work with the seller and more importantly, the bank to structure this deal, we have a low denominator, which generates a much higher return on investment.
Yeah, David said, does this mean a 115% return on investment or a 15%? No, that's a 115%. I know it sounds almost unbelievable. It's such a ridiculous number that we'd be able to have such a high return in such a short period of time.
So take out the fund, take out everything. Let's assume that we had just raised, say, 2.5 million to acquire this building. And today we were selling it for, say, 26 million. That would generate a $3 million profit because we paid 23 million for it against 2.5 million of down payment. So 3 million divided by 2.5 million would be over that 100%. That's like the really simple way to think about it. Now, this building is in a fund and there's other assets involved and we're continuing to spend the capital. But if we just look at the dollars that were spent on this asset, that's how we come up with that number.
Yeah, great question there, because it does seem like a huge number, and it is. I mean, we don't ever see anyone else have return profiles like this. And we may never get a return like this ever again. We probably will, but this is definitely home run level returns. And we couldn't be more proud of our outcomes here. So one of the reasons why we think the asset has improved in value is because the Berkman sold. So here's a little map of the Berkman. So you can see it is a 2-minute drive from Nicholas to the Berkman. You can see both of them are like immediately adjunct to the Mayo Clinic St. Mary's campus. The downtown campus is just to the right of the Nicholas. So Nicholas is right between the two campuses, an even better location than the Berkman. I would say it's a categorically superior location to the Berkman there. So the Berkman is a class A all the way, like one of the nicest apartment buildings in the United States, I would say. And some people said that the developer, who's a super awesome guy, was a little crazy for building this in Rochester. Because remember, Rochester is technically just a town of 150,000. Why would you build like one of the nicest apartment buildings in the United States in such a small community? Well, that building opened in the spring of 2020, just in time for COVID. Couldn't have had worse timing for their business model. And they just sold it for $187 million. So this is actually the single largest single asset real estate transaction in Minnesota history. One of the larger single building transactions in the country outside of New York, LA, Chicago. It's an extraordinary building, and it's an extraordinary proof of concept that there's a lot of appetite for institutional grade assets in our community. Like the Berkman was just a test, right? There's going to be many more projects. In fact, a new project was just announced here, Civic Center North. That's just north of the Mayo Civic Center downtown, and that's going to be another. I would describe it as Berkman class asset. And so this building has a rooftop pet garden and pool and yoga studio. They are actively working on tunneling into the Mayo Clinic underground. Like the level, the foundation system alone for this building costs more than most apartment buildings. So it's difficult to articulate just how nice of an asset this is. And again, this asset is right down the street from the Nicholas. So it's nice when the next door neighbor sells for more than anyone else has ever sold in history. And that's exactly what happened. We knew that this was happening, that the asset was being offered for sale when we got the Nicholas under contract. And we knew that it was going to be very accretive to the value of the asset when that transaction eventually did close. but we were blown away. $500,000 per unit is approximately what that Berkman sale translates into. 500,000, $500,000 per unit. So if we're at, half of that for Nicholas, that would translate into our $26 million valuation.
Yeah. And, we've known that Berkman was being built since about 2016 or 2017 because we watched it being built. And so we've been targeting this area. This is an area called Kutsky Park. We've been targeting it very hard for all of these years, first acquiring as many single family homes as we could, and then acquiring as many multifamily buildings, and then really building this relationship with the Nicholas sellers for years to let them know that we would take great care of their asset, that we're a family just like they are, that their oldest son is Nicholas and Nick happens to be named Nicholas, just building that relationship and letting them know that, of course it's a business deal and, they're investors, we're investors, they're business people, we're business people, but that there was that family connection. Yep. And so we were able to build that at the same time that we're really watching this community change because of the cultural change that the Berkman has brought.
Yeah, absolutely. How much was your loan to purchase ratio if you include vendor debt? The seller, Carrie, it was a 90% LTV on our purchase there. All right, well, let's talk a little bit about our single family homes.
And there are some other questions. I've been kind of watching them, and we will get to all of the questions. We're trying to weave them in if it makes sense to weave them in at that time, but then otherwise we will have a time at the end where we just do questions.
Yeah. Single family homes.
So single family homes. So this is another way that our fund is a little bit different. So usually funds target, large multifamily buildings. If anything, Nicholas is kind of small for a fund. And we target both large multifamily buildings and single family homes. And we love single family homes. We're always asking ourselves, I think, because people ask us to do it, like, are we going to graduate from single family, or is single family worth our time, or all sorts of things like that. And we continue to love single family. And we think that the big players like Blackstone and American Homes for Rent, they love single family too. One of our mentors, how large is his fund? You know who I'm thinking of?
100 million.
100 million of all single family homes. So we love them.
Yep.
And
I
think
we're a KW, team, and this individual owns more KW franchises and teams and stuff than anyone else in the country. As a good friend of ours, I would describe, and just by coincidence happens to be doing a $100 million single family fund. So we're thinking, if he's doing the same thing we're doing, then we're probably making good decisions.
Yep. So one of the unique things about this fund is it has both large multifamily and single family. And one of there's many reasons why that's good. It helps with placing capital. It helps with turning the capital over faster. It helps with some diversification. The financial metrics of multifamily and single family don't always run in the same way. I mean, they are right now, but that isn't always the case. So maybe if multifamily is having a tough year, single family is going to do really well, or vice versa. And so we love single family. Nick and I have been doing single family for over 10 years. It's where we honed this business plan of buying assets, improving them, holding them, doing a cash out refi, and then reinvesting that money back into real estate. So outside of the fund, our personal portfolio, we have a batch of single family homes that we re-levered about 2 years ago, and we got $1 million of liquidity. And then we just re-levered that same set of properties again and got another $1 million of liquidity.
The exact same portfolio. Yep.
Yep. And we're basically using that to build our townhomes. So we're taking that exact same business plan and putting it into a fund model.
And we even got one property back. Because we had now exceeded that bank's lending limit with that exact same group of properties. So that golden goose or sheep we can keep shearing, whatever. It's an incredibly powerful thing. We haven't seen anything like it anywhere else.
Yeah. So although that real estate's, obviously not owned in this fund, and past performance doesn't necessarily predict future outcomes, I wanted to explain that so that you all understand exactly why we love single family homes and exactly why we think they're such an important asset for this business plan of turning capital and getting to an infinite rate of return as quickly as possible.
So these stats are a little old. Again, we've probably added, I think, 7 more properties since we put these stats together here a couple of weeks ago. But basically, our business plan is we buy properties with cash. We typically do some kind of renovation to them. Sometimes it's a small renovation, sometimes it's a big renovation. And then we'll do a cash out refi. We'll put financing in place. Sometimes we're able to get the banks to even give us, a favorable cash out refi, give us more than we put in, or give us a greater value than purchase price, even though we're, financing it, a month after we bought it. Sometimes we're able to do that, sometimes not. But we're able to get better pricing. And, in this market, we're able to get the deal when we buy with cash. This is how we have built our entire personal portfolios with this exact same business model. And then, a couple of years from now, we're going to go and refi these properties and really realize the forced appreciation from those renovations and whatever organic appreciations happen in the meantime, pay down and return capital to the investors, and just do that over and over and over again, exactly like we've done with our personal portfolio for many years. Things have, it's been a tight market for acquisitions. We've been working our hearts out to get good deals, and we are really excited to see, maybe a little bit more equilibrium come back to the market, where it's going to be a little bit easier for us to get fantastic deals on properties. But we've been able to grow the fund, I think, at a very steady pace, and we're really excited with where we've landed in the mix of properties that we have in the portfolio right now. Despite the headwinds for acquisition, leasing performance is off the charts. So 1.4% global vacancy rate across our whole portfolio. Our team got 18 leases in the last 7 days. We run the stats every Monday. Just an unreal velocity for leasing. And, just like most places in the country, rents are very high. Rent growth is very high here. We're seeing dependence on the property, but certainly double-digit rent growth in our area right now. So we couldn't be more pleased with how things are performing so far.
So in terms of future acquisitions, so we still have several $1 million of capital in the fund. And then when we do our first relever of the single family homes that we have in the fund, that will give even more capital. So we're working really hard on acquisitions. I would say we spend probably 20 hours or more a week on acquisitions.
We have two full-time staff members right now that work at least probably 30% just on acquisitions.
Yeah. We tend to have pretty strict underwriting criteria. We want really high quality real estate that has good bones. It's in a good location where there's a lot of intrinsic value to that asset. We want a proven business plan that we can, generate value to do a cash out refi. So we don't just buy everything. And that's part of the reason we structured our fund with no pref, is so that we didn't feel an unnecessary urge to spend the money on something that isn't going to generate returns just to deploy the money. And also why we don't take any acquisition fees.
That's right.
Because you can imagine that if we knew, if we spend this capital, we're going to get a big payday, that could incentivize us to spend it on just anything. So we're going
that's such a critical point. I want to just reiterate that. So, we don't want our investors' money burning a hole in our pocket. So that's why we don't pay a preferred rate of return, and we don't collect any fees. So we don't have an outsized incentive to place the capital in maybe lackluster deals just for the sake of placing the capital. Most fund managers and syndicators, they make the majority of their money, when you close on the buy side. That's when they get the most amount of fee income. And so they are just hyper motivated to go spend that money in wherever they can place it. We've deliberately set up our fund without those mechanisms in place to keep our incentives completely aligned. We want to spend the money as soon as we can, because we want to generate profits and return capital so that we can then participate in the profit. But we don't want to go any faster than we need to, because then we might end up, paying too much for property. So like this moment in time, it's a hot market. And I think this is when our business model shines on the acquisition side the most, because we have the freedom and flexibility to make the most prudent decisions for our investors.
So we have several offers out. I mean, we're always acquiring single family. The good thing is those are just a nice steady pipeline. I think Nick wrote 2 or 3 offers on single family homes just today.
Yep.
And then we have 2 live offers out for multifamily. With single family, we don't necessarily do a large announcement to the fund. Sometimes we post it in our Facebook group or our newsletter, those sorts of things. When we close on another multifamily asset, we would do a larger announcement to the fund.
Yeah, I think, I don't know, we've written offers on several multifamilies we haven't gotten, but the one we're working on right now, I feel much more optimistic than most. And I mean, it's going to be a home run. If we can get it closed, that's definitely going to be a home run deal, and makes me glad we waited. So we're very excited about that opportunity.
Yep. The other thing that we could potentially do, I'm sure many of you have seen that we're soon to be launching Fund 2. We will likely launch that in the first or second week of June. And that would be to acquire, so we're acquiring Tanara Villa, which is a 130 unit community in Tacoma, Washington. It's about a $25 million purchase price. So Tanara Villa will be to Fund 2 as Nicholas is to Fund 1. It will be the cornerstone of that fund. And what Fund 2 could also allow is that if we were to acquire a large community, say 40 or 50 million, Fund 1 doesn't have enough capital to acquire that, but Fund 1 and Fund 2 together could acquire such a building. So let's say it's a $40 million building and we need, say, $10 million down. Fund 1 could put, say, $2 or $3 million into that $10 million bucket to get a proportional share. So that's another option that's out there where Fund 2 will give Fund 1 more options.
Yeah, at our current pace, we will deploy on the first, turn of the capital, 100% of the capital from the fund probably in the next 60 days, somewhere in that timeline. So I'd say we're more or less kind of nailing our time frame. Back when we launched the fund in December, I think we said, Fund 2 would come around June.
Yep.
So I think we're just like perfectly on track. I wish we had maybe gotten, another large multifamily in Q1, but it was the worst, inventory quarter for multifamily and for which we have data. So I'm not surprised. I mean, there's plenty of opportunities. We wrote an offer on a $9 million deal that, we refused to overpay for it. So, I mean, there've been multiple opportunities that have kind of slipped through our fingers by just a small margin. And there's a saying in real estate, it's the properties you don't buy that make you wealthy, not the properties you buy. And there's a lot of properties we haven't bought. I mean, I should probably track it. I bet we've written like at least 100 offers for Fund 1. We just, there's just a lot of things we haven't bought here. And I couldn't be more excited about, the pacing and the quality of the assets that we've gotten into Fund 1.
Yeah, Mark says the value of a property is most important when you buy, when you sell, and when you refinance. And we absolutely couldn't agree with that more. Particularly, you make money in real estate when you buy, which seems maybe a little bit counterintuitive. One might think, well, you make money when you sell, and then in our business model, you make money when you refi. But it's really, you make money when you buy, because that's what sets the trajectory and the timeline to get to those other events. So good point there, Mark. We totally agree.
And feel free to pepper in other questions. We're doing pretty good on time here. I'm pleased with our progress here, so I'm sure we'll have time for some questions at the end as well. So forced appreciation, basically, we physically renovate the properties, we improve their management, we drive, net operating income improvements to multifamily assets, and physically make our single family homes, have better comparable sales, better appraisals and potential sales value. We've enjoyed, I think, very good forced appreciation. $3 million in forced appreciation on Nicholas in 1 quarter alone, that 115% return on investment for that asset.
Theoretical.
Theoretical. Yep.
Theoretical.
And at this time,
not yet realized.
Yeah, for the single family homes, we're just valuing the purchase price. So we have put, a lot of time and effort into those assets, and we know the assets we bought back in January are already worth more. But we're not gonna put a number to that at this time, and we'll wait probably a year, I think, before we give ourselves any material credit there. There might be a couple of like really deep value add renovations or something where we give ourselves some credit, but we want to be conservative in all of our estimations.
So Fund 1, as all the funds, targets a long-term hold strategy. So we like to say at least 20 years, somewhere around like 20 to 25 years. And again, I want to reiterate that the capital goes back to partners as quickly as possible. So our timeline for that is, we tell people to plan for a 5-year hold, but we're really working as hard as we can to get that back as quickly as possible. Historically, it's taken about 2.5 to 3 years. And sometimes with our home run deals, we can do it in like a year. And then after that, we're in that infinite rate of return period. And that's where this 20 or 25 year time frame comes in. And again, the reason we don't say, oh, this fund is closing in 2042 is, what if 2042 is a tough year for the market? So we give ourselves flexibility, which benefits the investors because you don't have any money left in the deal. So you want us to wait until there's an optimal time to sell. And during that time, there will be increases and decreases. And right now we're at the top of a market cycle. So it could be that over the coming years, there's some decrease. One of the things that Gary Keller taught in his personal mastermind that Nick and I are in that I really like is, real estate is a yo-yo and you're going up an escalator. You can kind of imagine that in your head. So there's the yo-yo, and that's what kind of gets in the news or hyped about, or people asking, is there a crash coming, or is the bubble going to burst, all those sorts of things. But then that yo-yo is on an escalator. And by having a multiple decade hold period to ride that escalator up, the fluctuations of the yo-yo don't matter nearly as much. So we expect that all of these assets will have very significant market appreciation over a 20-year hold. And then at this time, we're not, kind of like Nick mentioned in the previous slide, we're not estimating any market appreciation at this time. We'll likely wait until at least Q1 of 2023 before we make any estimation of the market value of the single family homes that are in the fund.
Yeah, in terms of our forward outlook, we really couldn't be more excited. So the Mayo Clinic has more job openings than ever before in the history of the enterprise. They say the number one hurdle to filling those positions is the availability of housing in Rochester. So vacancy market-wide in Rochester is at 3.5%. Anytime vacancy dips below 5%, that's considered an extraordinarily low vacancy rate. Rent tends to grow at an exponential pace anytime vacancy drops below that 5% rate. By comparison, Rochester had a 17% vacancy rate as recently as 2017 due to the insane amount of new construction in the community. The next door community, Byron, where we're building our Stonehaven townhomes, we're permitting our next 60 units there and looking for like a 1,000 unit phase where we piece of land where we could put like 1,000 units. And we just found out that the city actually put a moratorium on all new building permits for a year because there is so much growth that it's overwhelming the city, and they don't know what else to do. So for the moment, they're just putting everything on pause. All the existing projects will move forward. Stonehaven will move forward. So if that gives you some idea of the extraordinary amount of growth here, when your local municipality just puts everything on hold, that's an incredible amount of growth. So we're seeing pretty limitless demand, pretty limitless job growth, and very healthy population growth to go with that.
So depreciation is, of course, one of the major benefits of investing in real estate. There's actually a little typo here. We closed on Nicholas and Oliver on December 28th, which was essentially the last day of the year that the bank was willing to write these large contracts, have their attorney available and those sorts of things. That was quite a feat to do that. We closed on 3 other apartment buildings that were not in the fund. They predated the fund, also in December. And when we got those under contract, we had told our team, this is it, guys, we're going to wrap up the year. I think those closed December 14th or 16th, and then we'll kind of have smooth sailing into the end of the year. And then we said, oh no, wait, we're going to close on a 100 unit building on December 28th. But the management transition was great. It made sense for the seller, and it of course made a great deal of sense for us as the buyer and for all of our limited partners, because that allowed us to share out depreciation with our 2021 K1s. So despite the fact that we only spent about 2.5 million, and again, it was really less than that. It was really more like 2.35. I'm just using some shorthand there. We were able to generate. So we basically spent about 25,000 of every 100,000 invested, but we were able to generate about 30,000 of depreciation for every 100,000 invested. So really generous depreciation was shared out for our 2020 K1s. And then of course, for our 2022 K1s will be the depreciation from anything that's acquired this year, plus the extra depreciation from Nicholas and Oliver.
Yeah, and of course you can get depreciation with lots of different private equity funds or syndications, but 99% of those are going to be targeting that 2 to 5 year hold period. In fact, the vast majority of private equity funds have a mandatory exit 5 years from inception, regardless of whether or not that's a great time for you to liquidate your assets. So there's just massive tax advantages to us because we are sharing out that depreciation, but then that depreciation is not going to need to be recaptured anytime soon because we're targeting this indefinite hold period. In fact, we hope you get your capital back and go into the next fund and the next fund and keep getting more and more depreciation with really no upward limit with that business model. So the depreciation advantage here is kind of off the charts. So we spoke to this briefly, but here's the numbers that aren't in the fund. I would say a typical fund or typical syndication is going to have something around the neighborhood of a 2% acquisition fee for an asset for an asset basket this size, perhaps a 1% loan recourse fee, which would have been required. So that was basically how we got the bank to agree to assign the note. Was Elaine and I are personally signed on that note, which is again really unusual in the private equity fund or syndication world. Most people are trying to do non-recourse loans so that if the deal blows up, you only lose investor capital. Well, we'd really hope to just not lose investor capital in the first place. So we're signing on the note, and we have a great deal of skin in the game as a result of that.
Mhm.
But in cases where a fund manager or a syndicator sign on the loan, sign recourse, they typically charge a fee for that. And frequently they'll even get like some other high net worth individual to sign on the note, and they might charge a fee for that as well. And then typically there's an asset management fee as well of 1 or 2%. Not a lot of income yet because we're just placing the capital, so that asset management fee has not grown to a huge amount yet. But altogether, about $787,000 in fees that typically would be charged on a private equity fund of this structure, which we're just incredibly proud with. There's no fees. There's no fees. In fact, the overhead is also, this is something that it's not talked about a lot, but there's a certain, I would say, lifestyle that syndicators evoke, where they're constantly on an airplane and traveling to sexy, places to live, to check on their assets. And that travel essentially happens on the investor's dime. All that airfare and car rentals and hotel lodgings and stuff, those are charged to the investors as asset management fees or as asset management costs associated with just operations costs of the fund. Those happen below the line. They happen after your NOI is calculated. So they're frequently not aggressively disclosed in any way, shape, or form, not included in financials. This is good. This is ludicrous, frankly, but for an $11 million fund, the only administrative expense we had was $8,700 for the K1, for all the K1s, because there's a lot of K1s we had to pass out. This is just an insane low, expense ratio. You might expect to see 10, 20, 30 times that kind of expenses on a fund of this size. But hey, the asset's in our backyard, and so we don't need to hop on a plane and charge investors for the airfare. I like to just visit the place for the fun of it. I just enjoy going to see it. I drive by it if I happen to be in the area. No need to charge for the trip. So it's difficult to overstate just how unusual this is, the fact that there's no fees, and then the ridiculously low overheads associated with this. And the cost of Inception is certainly not trivial. Elaine and I have spent a fair amount of money. I guess I don't know how much, but a fair amount of money on
Probably 50,000.
Yeah, something like that to spin up the fund, which is also low by industry standards. You could easily spend 250K spinning up a private equity fund. But again, we're just very efficient, kind of ruthless in our efficiency in all things. And so that's a cost that we paid out of pocket to put the funds together.
Yeah, we're certainly very proud of the fact that our private equity fund has no fees. And, those of you that have heard from us before know that, one of our missions is to change private equity, to make it so that something closer to this is the model.
Mm-hmm.
And really seeing that number, putting pen to paper and seeing how much of in fees could we have collected. And again, that's just this quarter alone. There are many, many, many more quarters during the lifetime of this fund. And that it's almost $1 million in just quarter one.
Mm-hmm.
It certainly makes us very proud, and we love putting our investors first. And there's a real number to it there. Someone asked about how do you pay yourselves? Are you both employees of Black Swan Real Estate? If so, when did you make the transition from putting single family rent checks into a business account and just withdrawing some profits for yourself versus whatever your structure is now? That's a good question. And we are radically transparent. So kind of the short version of it is Nick and I started investing in real estate about 11 years ago. All along, we were employed. I was employed as a psychiatrist, Nick as a technologist. And so we funneled all of our real estate profits back into real estate, all of our cash flow and all of our cash out refi proceeds, kind of very similar to what we're doing with the fund, so that we could keep acquiring and growing our bucket of real estate more and more and more. And it's really only been over the last 2 years that we have lived off of our personal real estate holdings, the profit that we generate there.
Mm-hmm.
Even our cash out refis, we churn those back into bigger properties because we want a bigger and bigger empire. We want to have more and more impact. And then we live off of the cash flow that our properties generate. We are also employees of our property management company. Excluding our salaries, we try to run our property management company at essentially a break even. So as we're growing our assets under management and we're growing our property management income, we're hiring more people. We gave very large raises to most of our staff this year, adding new benefits, just all of the things that need to happen to have a world-class property management company. Kind of the opposite of the profit first model, if you've heard of that, where you take
a terrible idea.
you take profit first and then you grow your business. We think of our property management company as, it's almost like a baby of ours. We grew it from infancy, and we're kind of watching it become a young adult today. And we're churning as many resources as we possibly can back into that. So that's a pretty deep dive into our personal finances. Hopefully that's helpful there.
And to be maybe a step further transparent, like, we want you to be so excited about this that you reinvest for the next fund and the next fund, and you tell your friends. So please tell your friends. One of our greatest mentors in the private equity fund space is Christian Mack. We talked to him about how frustrated we were with how a typical private equity fund was structured and the disalignment of interest that we saw. And he was like, well, then just make it up, do it however you want to do it. And we're like, but you can't do it that way. He's like, sure you can. Just tell the attorney what to do and write it up. And he showed us how his fund operates, which is very similar to this. So we're actually going to be doing a special purpose vehicle for Fund 3, the Fund 3 that he's doing. And he had a huge vision that basically had the same philosophy of how can we deliver insane returns to people in kind of our earlier funds so that our later funds are wildly successful. So he's on Fund 3 in the tech space. That's, my old, domain. It's a $150 million fund. He'll probably hit 200 million, and Fund 4 will probably be $500 million fund. Now, who cares about $1 million in fees on Fund 1 if you can make your way to doing a $500 million fund? And that's what our goal is, very, very transparently, is to just, shower our investors with abundance and insane returns, so that they'd be crazy to put their money anywhere else. And then when it does come time for us to do the next fund and the next fund and the next fund, it's not difficult for us to raise that capital, because we're very, we know how much personal profit we could one day draw from having a $1 billion fund. And we don't need those fees today to put food on the table. Fortunately, we were financially free before we started this whole thing with the private equity fund. And we're very intrigued at the impact we could make on the world with a $1 billion real estate fund. I'm going to brag on you for a second. So Elaine,
I'm really curious what this story is going to be.
Elaine has built a school. I can't think of a more succinct way that helped the school our children go to be in a new campus that's like 10 times bigger and half a century newer, and it did not have an adequate playground. So Elaine came home one day and she's like, hey Nick, I gave $30,000 to the school to build a playground. And I'm like, that's awesome. The cool thing is not that we did it. The cool thing is that we could.
Yeah.
And it wasn't even a conversation like, hey Nick, can we give 30 grand to the school? It's like, yeah, of course we're going to. This is the whole reason to have money. Yep. People who say money can't buy happiness didn't give enough of it away. And
that came from our foundation, the Stoggenberg Family Foundation. So no doubt there's people listening here that participated in the building of that playground. It's yet to be built. It will be built this summer. But for those of you they're new to us, we have a course, Single Family at Scale, because so many people ask us, how do you do this? How do you do this? What's your business plan? Will you do it for me? And we created a place where there's 100 videos, and we literally give away our entire playbook, exactly what we've done to build the business that we're building, that we built all these years and that we're still running today. And we didn't want to overcharge for that, or particularly in the physician space, it's very easy to overcharge for a course simply because the buyers have disposable income. And so we set that as a give what you can payment model, and 100% of revenue goes to charity. So we absorb all of the costs for that. So we paid our attorney to set it up, and we pay for the tax filing fees and the website and all of those things. And we've raised over $100,000 through Single Family at Scale. And so a small portion of that is going to the playground.
Thank you all for building a playground.
Yeah, seriously, thank you all. The real estate is fun. I think the real estate will be fun for many more decades. Doing these sorts of things is very fun. Changing private equity. So the questionnaire that our attorneys gave us, that they give to people who are creating funds, it's like a 7-page questionnaire, and the first 2 pages are all about fees.
Literally. All the different clever ways you can opaquely charge fees, and how much are your fees.
Yeah. And, as a psychiatrist, the thing that I always knew was the first thing and the last thing that my patient said to me in the appointment were the most important things. So that is the first thing on the questionnaire. That's the most important thing to people who are in our shoes. and we just put an X on it. And our
Well, first we didn't fill it out at all. We didn't fill out the fees.
Yeah.
And they're like, oh, you missed the most important part. And we're like, no. We had to like literally like X it out.
Yeah.
For them to
They're
understand.
like, do you not understand? Or do you have questions about it? And we're like, no, we're just not doing it at all.
We're like, well, how are you paying for our fee?
And you know, I think everyone here that's a limited partner needs to be asking, well, why isn't that form? Why isn't the first thing on the form? How is capital protected? How is profit generated for me, the investor, not what are the returns? And this is a great attorney. So we work with, you know, one of the best attorneys in the industry. I'm not saying anything negative about him or his practice. He is providing what his clients want, which is how to generate these fees. And we said, we're going to do an entirely different model. And here we are today. And all of you, speak to that success that we were able to raise this capital so quickly and deploy it in such an efficient way. And we're really excited to share this first quarter update with you all.
Yeah. So you all are invited to come out to Rochester, July 15 to 17. If you go to meetblackswan.com and I believe Rachel just put in, or no.
I think that's the course.
Yep. Earlier in the chat, Rachel put in a link. She can probably put it again to the conference. Again, most fund managers, there's this level of opaqueness, between the investors and the tenants and the property management company and the assets they're investing in. And we want everyone to come on out. We're going to have our whole staff there. I bet a tenant or two shows up. We want our investors to see, touch, and feel the assets that they're invested in and see how their money is going into Main Street instead of Wall Street. And we just couldn't be more proud of this level of transparency we're able to offer. We're going to have teaching and speaking and coaching. The state senator for not our area, but a state senator will be there doing.
He's the operating principal of our Keller Williams office. So where we are right now is our Keller Williams brokerage, and he's the operating principal. So one of our mentors and business partners. He's
in the National Guard, and he's a volunteer firefighter.
And he served on the school board.
And he's on the school board, and he's a state senator.
And he has 3 kids.
And he has 3 kids, and he's out. So he deployed to St. Paul with the National Guard or with the fire department. Then deployed to St. Paul with the National Guard. Then deployed to Afghanistan with the National Guard. All the while, I'm doing a coaching call with him from Afghanistan, and I'm like, one of the people that make us feel like we're not doing enough with our life here.
Yeah, so Nick shared, our mentor Christian Mack that really opened our eyes to what's possible in private equity, and it's Zach who really opened our eyes to what's possible in giving and serving, and he'll be our keynote speaker. Yeah, so we're really excited about that.
So lots of fun stuff. Come on out. I think it could be life-changing. It's going to be a ton of fun. We're going to have childcare provided. It's going to be, I promise it will be unlike any other conference you've ever been to. We're going to have a ton of fun with that. Fund 2 is coming soon. We're under contract on Sonora Villa. We've got a couple other really hot irons in the fire that we'd love to announce in parallel with that. I don't think the time is going to work out, but we'll be launching Fund 2 here imminently. More or less an identical structure to Fund 1, just with kind of larger geographies, opening us up to a few more opportunities. And we're unbelievably excited to launch Fund 2. We'll probably be raising this fund, in a day, similar to Fund 1. And we expect to have just as much fun with Fund 2 as we've had with Fund 1.
Elizabeth asked a question about when will there be a dedicated discussion on Fund 2? So likely the first or second week of June. We have a couple other big offers out there, so we're kind of slow playing launching the fund so that if we got that second thing under contract, we could announce both. I think it's very likely that we will launch it with just Sonora Villa, and we're very excited about that. And then in terms of pulling off something, so her question is interested to hear about how you all will pull off something similar in Washington, given how much of our local connections and reputation means to the success. So we've been investing in Tacoma for over a year. So we identified that market about 4 years ago on a trip where we went specifically to do due diligence as a potential real estate market. And then most importantly, after we decided that we had an interest in investing in Tacoma, we found a partner. And so we spent years looking for an operational partner. And we found someone who's very similar to us. So he's vertically integrated. He owns a construction company and a property management company, has been doing this for 10 years. It's kind of funny when he looks at our renovations and when we look at his renovations, we use the same paint scheme, the same granite, those sorts of things. And some of that's just the trend right now, but it's eerie how similar we operate in the way we think. And we have proven success there. So we
Yeah.
purchased Garden Court West last year. That was a $9.8 million acquisition. We've done about $2 million in renovations, and we're completely cashing out our investors in that opportunity, and they're rolling all of their capital into Fund 1. And then Tanara Villa
Into
is,
Fund 2.
I'm sorry, into Fund 2.
Yeah.
Thank you. It's getting harder and harder to remember the numbers.
Yeah.
So we have proven success there with this business model, with this operator. And then Tanara Villa is just a carbon copy of that, but larger. Garden
Yeah.
Court West was 64 units and Tanara Villa is 120.
Yeah, excellent question.
Yeah.
So we've got the community power hour coming up. That's Ask Us Anything. So ask me anything, AMA. Oh, it's plural. Yeah, Ask Us Anything,
Yeah.
AUA. So bring your questions, and we're happy to answer questions about real estate, about life, about babies, whatever you want. Feel free to ask us anything. I think that's going to be a lot. I hope people bring fun questions for that.
Yeah, those of you that have come to many of those know that we usually have a teaching topic, but we felt like right now there's just kind of a lot going on in the market and people have a lot of questions. And so we want to open that time. And then it's very similar to what we do in our single family at scale group. We have a smaller once monthly coaching call that's only for students of that course. And we go over people's deals and what they're seeing in their market and structures that they're putting together. So it will be just like that, but on a much larger scale.
Yeah.
A simple question popped up there at the end. How many investors in Fund 1? There are 73 investors in Fund 1.
I'm glad you had that exact number right off the top there.
Yep. All right, so we will do some of the questions that came through that we didn't answer as we went along. And then certainly if you have more questions, feel free to pop those in the chat and we'll make sure we answer those.
Yeah. Is return of capital distributed all at once, or is it returned by a monthly, quarterly, or yearly payment? So we don't have any distributions right now. As we said in the webinar for Fund 1, we're placing capital right now. A lot of syndicators or fund managers will actually return some small amount of cash flow as the investment kind of launches, which intuitively probably shouldn't make any sense, right? So if you are literally spending money on acquisitions and then probably doing some deep value add renovations, you're vacating units and having escalated carrying costs, like how is the opportunity throwing off cash flow like that? That shouldn't make sense. And usually it's kind of an optics thing where they'll just overraise and then slowly return that capital to investors to simulate cash flow, even though the underlying opportunity does not actually cash flow. We don't do that. That doesn't make any sense. That just lowers yield, lowers returns for our investors. So I don't expect we're going to have a lot of capital return to investors this year as we're placing capital, running through those deep value adds. And then basically the moment we're done placing capital, which will happen, probably in the next few months here, it'll take some time to get through, kind of turns the capital we'll buy. We'll spend like 8 million, on properties, refi those out, and we'll have 6 million left, and we'll place that 6 million, we'll refi those out, and we'll have 4 million left. So we'll get smaller and smaller, those turns of capital, but that'll wind up here as we get, through the end of the year. And then once that's done, we'll start returning capital in earnest. So it'll be cash flow distributions quarterly. And then, let's say it takes, 2 or 3 years for us to get to a big cash out refi. That's when the bulk of capital will be returned.
Very good question. I would say that's like the number one question that we get. Interestingly, from people that are also in the fund. And so I do want to make sure that I hope that everyone understands the structure, but particularly those of you that are in the fund, we really want you to understand that. So hopefully that helped. If not, listen to the recording. If you still have a question, shoot us an email or book a time on our calendar. It's a unique structure. And again, we're really targeting getting to that infinite rate of return as quickly as possible, but also having the largest amount of assets so that when we're in that infinite rate of return period, it's the largest amount of return that's coming. Very good question. Thank you, Zach. Elizabeth asked a question, what did you do with the excess 5 million raised? So what she's referring to there is in the beginning, when we talked about the success of Fund 1, we mentioned that we raised about 16 million in one day. And then we
just kept that.
No, we were only able to collect 11 million because of regulations that this is a business and there's a PPM there, and so we just had to turn it away. We basically it was kind of a frenzy of first come first serve of who signed the PPM and remitted capital, and then once we hit 11 million, we had to stop. So Fund 2 is larger, and I think that will help with some of that. And then we're also having a phased opening to Fund 2. So Fund 2 will first be open for 3 days to folks who are in Fund 1. and then for 3 days to folks who are on the fund to wait list. And then we will do our public webinar. But we expect we'll probably over raise and fill that fund in a day too. But that's what we had to do, is we essentially had to turn away investors.
Yeah. When will you refinance it? You have to wait 7 years. So when will we refinance Nicholas? So having a no interest, no payments loan for $9 million for 7 years, that's a tough one to refi, right? Because we don't really want to pay back that no interest, no payments loan, and then suddenly have to make interest and payments. So that asset probably will not refi anytime soon. We'll probably ride that out for quite some time. The sooner we refi it, the better the deal is for the seller, right? Because they saved, almost $1.5 million by doing the seller carry option. And the longer we ride out that refi, kind of the worse the deal gets for them. At some point there probably will be 8 figures of liquid or of equity in that asset. And that at that point, we probably will have a hard decision to make. And it depends, if interest rates are exceptionally low at that time, and we're able to procure a exceptionally, tantalizing, debt option, then yeah, if interest rates are, 7%, well, we're going to be in less of a hurry to refi that asset. In fact, the way that is structured, if interest rates were high, and we prepaid that loan, we actually might get paid by the bank to prepay the loan, because essentially we're relieving them of some interest rate risk in that situation. So even in that circumstance, we would still probably come out ahead on the deal, but we'll probably let that 0% debt ride out as long as it makes sense to do so. Excellent question.
And because we only spent 2.3 million of the fund, we can generate that 2.3 million back from other assets. So if say Nicholas was 7.5 million of the fund, this strategy would not work. So there's all these kind of factors coming together that makes it so that this is a viable strategy.
It's a huge strength of the fund. So on the acquisitions side, the fund is like bringing a gun to a knife fight. Like I will frequently write 3-4 offers in a single day, because every offer is identical using the exact same template. And then in terms of, being able to optimize our outcomes for our hold, again, if this was a single asset syndication for Nicholas, our investors, wouldn't get, that principal return of capital anytime soon. But because it's blended with other assets, some of the other assets might, return capital sooner than Nicholas, even though the, overall total rate of return on Nicholas might be higher. So we're able to blend those together, and it's amazing. It makes our job so much easier.
Yep. George asked, what is our standard rate for pet rent? So we charge $50 per pet per month. We don't have any like administrative pet fees or pet deposits or anything like that. We have a pretty competitive pet rent policy in our community, but it still generates, a lot of income. And ironically, we find that pet tenants are better residents. I don't know, kind of, there's a level of responsibility or something that's kind of outside of the scope of this call, but a lot of people ask us about damage to assets from pets. Of course there's some, but on the whole, pets are very, very profitable. A big part of it is that we plan for pets, like we're taking out carpet and putting in LVP. It's very hard to damage LVP with urine or accidents or even dog fingernails or those sorts of things. But we love pets.
That's hard to shoulder, right? So let's say we go spend $4,000 replacing carpet with LVP in an apartment unit. Well, that's a big cost. But let's say we then place a tenant in that unit that has 2 cats, and those 2 cats generate $100 per month in pet rent, or $1,200 per pet rent in a year at 5 cap. This asset's probably significantly lower than a 5 cap, but let's say it's at a 5 cap. That's going to yield $20,000 to $30,000 of asset value essentially from generating that pet rent, which dwarfs the $4,000 we spent on the LVP. But most people can't get past that maybe unnecessary cost of the $4,000 for LVP when we could just spend $1,000 on carpet. So you have to have a long-term time orientation in mind. But if you build your assets for pets are great.
Mike asked, how do you guys see rising interest rates affecting your pro forma, especially when looking at refinancing the single family homes in the future?
It's a $1 trillion question there, isn't it?
Yep, that is the $1 trillion question. Probably the question we got the most as we were launching the fund, and then certainly now with what's in the news and what has happened with the Fed. So first rates went up 0.25%, and then they went up 0.5%. So it's certainly something we think about. I think Nick and I probably talk about interest rates every single day. one thing that's important to message is that in the years that we've been investing, rates have gone up and down, and the business plan has worked through the ups and downs. Right now, there is so much more attention to the ups because this is the first time interest rates have gone up in several years because of COVID. But interest rates have gone up and down many times in the almost 12 years that we've been investing. So it's certainly something we think about. In terms of refinancing the single family homes. So one of the big advantages of commercial debt is that it's not as closely tied to, well, interest rates went up, therefore the mortgage rate has gone up. So the proposal that we're looking at right now is a 4.0, I think it's 4.05% for the single family home refis.
Yep. And we just locked in 5 million of single family homes at 3.8%.
Yeah.
So commercial rates have not moved anywhere near as much as conventional rates. So conventional rates were all the way down to 3%, which commercial rates only barely touched that rate. And then conventional, if you're doing like a multifamily conventional cash out refi, you're looking at like an 8% interest rate right now, but that would be like a 4.5% interest rate on a commercial note. So there's been a lot less fluctuation in the commercial market. And then I would say that Elaine and I have kind of sat out some of the frenzy in terms of purchasing in multifamily and single family, just being really kind of careful about it. We knew that these, low rates were a short time thing. They were not going to stick around, and we could never pencil in a deal on the assumption that those rates are going to stick around. There are some operators out there that went and got variable rate debt and interest only payments, locking in, it's only the 2% interest rate or whatever at a variable rate. Well, now their interest rate is, 4% plus, and suddenly their deals don't work anymore. Right now, I don't think we have any variable rate debt on the books whatsoever. We've locked in low rates. I mean, we've been kind of pounding the table that everyone needs to go get fixed interest refis since January. We all knew this was coming, so prepare for it. We've got debt, at low threes on a lot of our assets at this time. And so I don't know, we could spend a lot of time talking about this. I hope this speaks to your question.
Yeah.
That this is it's not rocket science. It's really pretty predictable if you just kind of keep an eye on the Fed and the news.
And one of our sayings is that for every hour we spend looking at a deal, we spend an hour looking at debt. So we take debt very, very seriously. It's a huge part of any real estate investor's business plan because of the unique way that real estate can be leveraged as opposed to, say, investing in a lemonade stand or something like that. So it's important. It's something we spend a lot of time understanding, working with our bankers, looking at options. But we feel pretty comfortable, especially given that we've been doing this for long enough that we've ridden interest rates up and down. Good question. Thank you.
Let's see. Would you please explain what was referred to on the first slide by the 50-50 split after capital return to the limited partners? So our structure is crazy simple. We're not sharing that screen, so we can share that out again.
Yeah, I'll share it out.
Yeah.
This one?
Yep, that's it. So our structure to our fund is to Fund 1 and Fund 2 and probably Fund 3, 4, 5, 6 is really like childishly simple. Our investors put money into the fund. We use that money to go buy real estate. That real estate generates a return. 100% of the profit, 100% of the return goes to our capital partners. So we don't take any fees or splits or anything until our investors get a full return of capital, which is extraordinarily unusual in the industry. Usually the fees come out first and then the splits come out after that, and then the investors get a return of capital. In a lot of deals, the return of capital doesn't occur until the deal sells. In our structure, 100% of the profit from any source, cash flow, refi, sale, whatever, goes to the investors first, and then it's a 50-50 split after that. So 50% of the profit comes to Elaine and I, 50% goes to the investors. That's it. There's no more complicated than that. So I hope that answers that question. That's a key piece of our fund for sure to understand.
There was a question about Garden Court West. So that's our 64 unit community in Tacoma that we're already exercising the cash out refi. So we'll get 100% of capital back to partners. And Shanker asked, will the Garden Court refi go into Fund 2? So the refi proceeds are owned by those investors. Yeah. So we called each investor and asked, what would you like to do with your funds?
We're starting on the refi process. No refi is a sure thing. We had a refi on a personal property here, Stonehaven Phase 1. And originally the appraisal came back at what we paid for it a couple of years ago. And we're like, no.
We're like, this wasn't a purchase appraisal. They were like asking us for the purchase agreement. We're like, the purchase agreement doesn't matter. It was 2 years ago. And then we're like, there's there's trouble ahead. And
So
that's exactly what
we're challenging that appraisal, and we're being successful in challenging that appraisal. We think
Yeah.
it's worth more like 9 million, but just refis are fickle. You know, it's not a done deal until it's a done deal. But
Yep.
but yeah, we're moving through that process.
Yep. So we called those investors and said, we will have an opportunity to give you all of your capital back in the next, say, weeks to months as we finish out this refi. What would you like to do? And 100% of them chose to place that capital in Fund 2.
Yep.
So we're very excited about that. Thank you. If there's any.
There's one investor that moved into a different opportunity. I think I don't remember exactly, but
Yep. Moved
Yeah.
into the townhomes.
yes.
Yep.
Okay.
Linda asked, how do we know if we are on the wait list? I've registered, but not sure it went through. Rachel, would you please look to see if Linda is on the Fund 2 wait list and Invest Next, please?
Great question.
David asked, is the fund audited?
So we are not like a fully SEC we're not like a publicly traded stock. So there's not that level of regime or auditing that goes with our private equity fund or any private equity fund up to certain levels. Once you get to certain levels, you get more audits and stuff.
That's what the regulation D 506C. That's what the vast majority of real estate investment syndications and funds are. And that means that they're not registered with the SEC. That's the exclusion, that they don't have to be registered.
So the SEC knows we're here, knows that we're raising capital, knows what the size of our fund is, but the SEC is not looking at our books. No SEC auditor is looking at our books the way like Google they might be. We have Brandon Hall, the real estate CPA, is our fractional CFO, and they audit all of our books. They do internal audit and control functions of accounting. So we don't do those in-house, which is a best practice to have a third party, outside party, looking at everything and giving their stamp of approval. Say, hey,
keeps me saying,
looks like nothing unusual is going on here, and they always have questions for us every week of, hey, what's this transaction and why was money transferred here and stuff. So they're executing those audit and control functions of accounting very dutifully every week. And then we just hired a full-time in-house accountant who specializes in control. So she managed an organization of 200 employees, so a much larger organization than us. And her area of specialty within that internal accounting team was control. Control's an incredibly important function for real estate specifically and property management, because there's just so much money flowing around. The only industry where it's more needed is finance. So there's a lot of control that's needed in our industry.
Martin asked, once investor capital is returned, will all available profits be returned to investors, or will you use it to buy other properties? And then he said apartment and house babies, because that's what we call them. When you have a house and it generates a cash out refi, and then you take that bucket of money and buy the next house, that's a house baby. And then there's grandbabies and all sorts of stuff. So once investor capital is returned, then all of the profits would pass through to investors. We do not intend to kind of hoard that money and then buy more assets. Part of it is that so that there's some streamline, that our accountants and everyone knows that this fund is done with that phase, and now it's in the phase where profits are being shared out with investors, and these future funds are in these future phases. And then also so that investors can have some sense of planning. So in the beginning, we ask for a lot of grace of kind of that sentence where we say, we plan for a 5-year hold of your capital. Historically, it's been like 2.5 to 3 years. Some of our home run deals, it's more like a year. But in that time frame, we're just asking you to hold tight and know that we're spending the money as best we can and getting that bucket of capital returned as quickly as we can. And then after that, there will be a lot of predictability. So investors will get quarterly returns of all of the cash flow that's generated. And then about every 3 to 5 years, as there are future cash out refi events, that cash out refi would go to the investors. It would not be used to buy more assets. Very good question. We've not had that question before.
That's a sophisticated question.
That's a new one. I like it.
Yep.
Martin's been working with us a while. He knows that
we can just keep making more money with that money.
He just knows
forever.
that we just love buying more assets.
Well, the goal is we return the capital, and then in conjunction with that, there will be another opportunity. So we're going to, hopefully return capital with Garden Court West as we work through that refi process. And because Fund 2 has an asset that's just down the street from Garden Court West, we of course went to those investors and said, do you want your money back? It's potentially going to be available here soon. Would you like to put that money into Fund 2, if and when that refi process completes? And so, pretty much everyone was very excited about that. So, sorry, I just choked on some saliva there or something like that. So the goal is, people roll their funds forward if they want to, but it's certainly an opportunity for people to divest, and people need to have that opportunity to divest if they want to put that cash somewhere else.
Yep. Mark asked, where do you think we are among the 4 phases of the real estate cycle?
So we're at a point of inflection, Mark. I don't think anyone knows. That's the honest to God truth. We don't have a single dial on our dashboard right now that says there's like any kind of crash out there. There is just so much liquidity, so much capital out there that's sitting on the sidelines. A deal transacted in Minnetonka here recently, $127 million. So one of the larger, real estate transactions in the country for one apartment complex. Minnetonka is a top flight suburb, one of the highest median income cities in the country, is top flight suburb of Minneapolis, St. Paul. But it's a 1980s Class B apartment building selling for $300,000 a unit or whatever. In the best and final round of that deal, every single one of the buyers could pay cash. Every single one of the buyers. So that means there is over $1 billion of capital chasing one deal. And the buyer ultimately did put leverage on it. And so they only placed, let's say, $50 million or something on that asset. So there's still at least $950 million out there circling, just looking for an opportunity, looking for a place to go. So there's no way that we can keep seeing double digit, 25% annual price growth. There's just no way that's sustainable. And I think we've seen the end of it, especially with rising rates in the single family space, probably more than the multifamily space right now, or I don't know. I don't know. But I also, there's no crash in sight. There's no way that prices can really go down because there's just so much demand and so little supply in Rochester alone. The Economic Development Authority does a study, and they show that there's currently a shortage of about 8,000 housing units in a town of 150,000. A shortage of 8,000 housing units between here and 2030. And the next town over just shut down, just did a moratorium on all new development.
So we're like super excited to hear that because we want
to beat the buzzer.
Well, we want to hear that they're 8,000 short because we want to solve the problem. And so we're building our townhomes and we're at 115 and we're, looking around at adjacent land and we're like, this is going really well. We could build like 1,000 of these, and they're built in 10 unit buildings. So they're like little monopoly houses. They're very easy to build and you just kind of keep going. You can kind of create an assembly line. Nick traveled to Nashville to learn from a very large scale builder to basically, exercise this pipeline model. And then the city said we're shutting down because there's too much growth happening. So there's just so much room to go, certainly in our real estate investing journey. So we started at the bottom of the crash. So we didn't invest through the crash, but we're very influenced by the crash of 2008. And that's where we learned to hold because we had assets that we were very underwater on and there was essentially no way to sell them. And so we became landlords. I don't like to use that word anymore. I prefer to use the word property manager. And then we've watched the value of those assets rise over the last 12 years. And we've made 6 figures on each of those properties alone. And so it's gotten better and better every year, but there's also been more and more risk and it's harder and harder to get deals. And so we're okay if it continues to go up. We're also okay if there's a little bit of a softening and it means that there's, potentially more deals and we're able to acquire some things that need a deeper value add. So I think we're pretty well positioned kind of, whichever way the market goes. But Jay Scott said recently, it's easy to invest when the market is going up. It's easy to invest when the market is going down. It's very hard to invest at the inflection point. And, Nick said we're at an inflection point. I think we're close to an inflection point or kind of there's like some swirling that maybe we're at an inflection point. I think it's yet to really be known, as things settle down over the next couple of months. There's just such a need for housing in the whole country. That's really the main driver, and things like COVID and the supply chain and labor and interest rates are so subordinate to that need for housing that it's a great time to be a real estate investor.
12 months from now, we're going to see 5% organic appreciation, and prime rate will be 5.5%. So those are you can jot those down, Mark, if that. We've been very vague. I'm going to throw some specific.
Yeah, Rachel, write those down. So Nick and I have a Google Doc internally. We call it, what do we call it?
Prognostications of the Oracle.
Yeah, it's such a beautiful name. And we literally just write those things down because we're always testing our ability to predict the future. the SEC is probably shuddering a little bit, but that's essentially what investing is, right? Is you're making a decision today with the plan that it's worth more in the future, and you need to get really, really good at that skill. And so we write down the things that we predict, and then we go back and look at them and talk about, well, why were we right about that one, or why were we wrong about that one, or this one, we were kind of close but missed it here. We spend a lot of time doing that to hone that ability to predict the future of the cycle. Good question, Mark. You always keep us on our toes.
Once capital's return, what kind of cash flow could we expect year to year? That's a great question. It's tough to say. So ours is certainly not a cash flow heavy strategy. I talked about how some syndicators or fund managers will kind of simulate cash flow even when the underlying asset doesn't necessarily actually produce cash flow. And we don't really, cash flow is not what makes you rich. Equity is what makes you rich. So we are just ruthlessly focused on equity. The overall pattern is basically you're going to see a lot of cash flow kick in less than a year from now when we've deployed all the capital and assets are producing cash flow. Then we'll start to do cash out refis on some or most of the assets. And so that cash flow is going to go down because now there's more leverage that reduces cash flow, but you're going to see a huge return of capital as we return the principal invested in the fund. At some point thereafter, cash flow will go up as the debt service stays the same from the new leverage, but rents increase. And so cash flow will go up, but it's never going to be super amazing. And then 3 or 5 years will go by, and then we'll do another cash out refi. And so like we mentioned, we just got a check for $1 million here last week on a cash out refi on a good chunk of our single family home portfolio. That $1 million like just completely exceeds all the cash flow we've ever made on that portfolio. And it's not the first $1 million check we've gotten from refinancing those homes.
Mm-hmm.
Equity is what makes you rich, and that's what the focus of our fund is. So cash flow is not a big focus. It's probably an unsatisfying answer for you to hear. I really don't want to throw out like a certain cash on cash rate of return metric. Just know that cash flow is not going to be a big piece of the puzzle. You'll be able to get all your capital back. You'll still have a huge equity stake in perpetuity in the fund, which is extraordinarily unusual in our industry, and that's going to keep throwing off infinite rate of return for the indefinite future. Sometimes from the questions we get from people in the fund, we suspect people don't really understand that part of it. They don't understand that they're in it forever. And it's not really going to sink in until like 10 years from now. They're like, why do the checks keep showing up? I got my money back 7 years ago.
It's certainly a weakness of our marketing. That, I see things on like social media of, oh, I got my first distribution check from XYZ fund. And I'm like, oh man, our fund's not quite delivering that yet. But our fund will still be delivering returns 20 years from now, 20 years after you've had all of your money back. And that's really when it will kick in. And we're young enough that we'll still be investing in real estate and hope
Fund
that
5 will be available
that you and your children but that's certainly it's a different piece of the puzzle, and it's really about trading we'll call it like a medium-term gratification, because it's not quite long-term. We're asking for 3 to 5 years to get that long-term gratification of infinite return as long as possible. Good question.
So after 100% capital is returned to LPs and 50-50 profits, after that, the LPs have a percentage of the investment left over. Like if all assets sell at 15 to 30 years when fund closes and dissolves. Yes,
absolutely.
That's the crazy thing that's awesome about our approach. Yep. So you own it forever. You're never,
well, until it sells.
Yeah.
So, we'll say that 20 or 25 years. So all the way through, you're getting your share of it. And then the day that everything is sold, all of that money goes back into the operating account, and then it's shared out to investors. And that would be the last large distribution that goes out.
Yep.
And then the fund would be completely closed and wrapped up and done.
There is one caveat to that. So at 15 years, we have what's called a unilateral call option with a minimum 15% hurdle. So basically, you have to have the ability to get your money back after 15 years with a minimum 15% total annualized rate of return. So, many funds have like a 7 pref or something. So we double that. So kind of an insane minimum hurdle for us to hit. At that point, theoretically, you could be removed from the fund, and we're somewhat required to have that hard exit in the fund in order to maintain SEC compliance. We don't plan on exercising that unilateral call option, but I do need to call that out very specifically, as that is a feature of the fund, and that's how it's technically a closed-ended fund. It's not like an evergreen fund or an open-ended fund.
Good question.
Yep.
Van asked about short-term rentals, that they're popular and potentially profitable. Do we have any future plans to enter that space? At this time, we don't. So, we certainly see that a lot of our colleagues are investing in short-term rentals. What I see is that, particularly high-income professionals it seems to me that they're investing in short-term rentals because of the potential tax benefits, maybe not necessarily for the love of the game or for the returns. I'm also seeing, and this is not like sophisticated market research. This is me with my colleagues on Facebook groups, and we're all kind of talking about each other's deals and that sort of thing. But vacancy this summer already. And I don't know why. I'm not an expert in the short-term rental space. At this time, we are still very, squarely focused on long-term residential real estate. That's what we've done the entire decade plus that we've been investing. It's what we've built our property management company around. We do have some like long, short, or medium-term rentals because we're in these very coveted locations where there's professionals that might come to Mayo for, say, 3 months or 6 months, or patients will come to Mayo for similar timeframes. A small portion of our portfolio goes to those types of leases, but that's really just because there's a need and there's an availability, and we kind of match them up. It's not that we set aside a portion of the portfolio to operate as like medium-term rentals or anything. And then we have an even smaller portion of our portfolio, like less than 1% or maybe 1.5%.
20 units out of 600 or something like that. That
we lease to a family here in Rochester, and then they operate them as a short-term rental. So things like Airbnb, VRBO. So we essentially have a master lease with them. So they're paying the long-term rental rates, and then whatever profit they make is theirs to keep. So that's kind of the closest we come to short-term rentals. It's a nice relationship because we're close with them. We hear about their stats, how their businesses are doing. We're able to flex with them. So when short-term rentals struggled because of COVID, there was a huge need for long-term rentals. So we just wound up those leases for them. So we're able to have a good business relationship. And then it helps us because we have a small portion of our portfolio that we have, kind of like a fixed low vacancy. So we were able to give some units from several of our downtown buildings to this family to operate, but that's about as close as we get. And unless you have some plans that I don't know about, I think that's as close as we'll get for now.
Yeah, I don't see us really entering that space. Running an Airbnb, you're operating a service business, you're operating a hospitality business, and we really want to be in the asset ownership and management business, not in the service business. So, there's a couple assets that have come our way. We have a pretty interesting one that's very much, could be acquired soon. That's an extraordinarily unique historic building in Rochester that would be exceptionally, well oriented to being an Airbnb. Maybe we'd consider it for that asset, but even then, it's something that we're slow to go into because we see a lot of focus loss doing that. And we also see a lot of risk. We see a lot of regulation risk. We also see very few barriers to entry there where other people can enter the market and kind of disrupt our advantage. We tend to buy assets that are high quality assets in great locations where it's not feasible for someone to just open up shop next door, but that's how Airbnb works. There's very few barriers to entry that allow, there are very few moats, Warren Buffett moats around your asset there. So it's just not a space that we've been excited to enter. And I think we've kind of voiced concern about the number of people we see getting into that space, buying, $1 million beachfront homes and stuff. And so far we have been wrong about that. Every year we know people who are making a very healthy 6 figures on their vacation rentals, and we've been glad to be wrong about that one. But it's certainly something we keep an eye on. We talk about it probably once a week. We talk about, should we be getting into the short-term space?
Yep. Elizabeth asks, is it possible to do a 1031 exchange into your fund, maybe from one fund to the next down the line? So long story short, no, because a 1031 exchange has to be the same owner sells a property and then acquires a property. So Fund 1 is acquiring a bucket of properties. And then remember, Fund 1 won't sell those properties for like 20 or 25 years. But even then, whatever is acquired would be acquired by like Black Swan Real Estate Fund 15, right? So Fund 1 would kind of cease to exist at that point. The more important thing to point out is that there's no real need for that. So because of the long-term hold of the fund, depreciation recapture is deferred for that 20 or 25-year period. Any proceeds that are shared with investors from cash flow or from cash out refi is a tax neutral event. So there's no capital gains paid on that at that time. It isn't until the sale of the property in that long-term horizon. So that's one of the unique things about the fund is, we joke we can't make the taxes go away. We wish we could. We're working on that strategy.
Yeah.
As of yet, we haven't found that strategy, but we have found the strategy to make them go away for as long as possible. So when people ask about, 1031 or, oh, this syndication's wrapping up, so I need to find the next thing, we just remove all of those problems by having that long-term hold.
This is a super common question for us to get, which tells us that we're doing a poor job of messaging like the most amazing thing about the fund, which is that we don't sell. So you don't ever have to recapture that capital gain. We do a cash out refi, you get your money back and you get debt, fully qualified recourse debt or non-recourse debt on your K1. So you get your money back with no capital gain to go with it. And then you can put that money into the next fund if you want to. When we were building our private equity fund structure, we talked to all the top people in the country that we could have a conversation with about this problem, because there are some people where they'll structure it so like fund 1 winds up and then fund 2 launches, and you can take your money back or invest in the next fund in that structure. But it's really complicated, and it takes kind of really tricky timing. And again, it's predicated on a sale. So the way we've structured this, we think is like cooler than anything else out there. Like your actual returns are going to be exponentially higher with this structure than with a different structure that, even if it could facilitate 1031, because you get to keep the original asset. So it's not like you're rolling into fund 2 and you're out of fund 1. No, you're rolling into fund 2 and you're still in fund 1 from now until the end of time. So great question there.
Let's save those 2 questions and then answer the last question there, Nick, and then
Okay.
we'll answer those 2 questions and then we'll wrap it up.
From Zach.
Answer the question from Vincent.
Okay. Do you anticipate the bonus depreciation with cost segregation on fund 2 to be the same split 50-50 for GP/LP as fund 1? I noticed some other opportunities provide 100% of the passive losses going to investors. Not a criticism and purely a curiosity question. And I understand all funds have different structures. Yours is much more simple. I appreciate you softening that question. That's such a polite question. I appreciate that. Great question. So we deployed 20% of the capital in fund 1 before the end of 2021. So one day before the end of 2021, and we ended up returning about 30% depreciation. So we deployed 20% of the capital and returned 30% depreciation. So already you can see that our ratio, I would say, grossly exceeds the industry standard, if there is such a thing, of for every dollar you put in, you get $1 of depreciation back, so to speak. So Elaine and I, we do split the depreciation. The reason why we're able to do that, by the way,
it's important to know this,
is because we are actually an owner of the fund. This is going to sound completely insane, but most fund managers, most syndicators are employees. They have no actual ownership rights in the fund, and this makes them exempt from recourse if things blow up.
And we sign on the note.
Yes.
So we have recourse, which allows us to take depreciation. If there's a non-recourse note, then the general partners cannot take the depreciation.
It's illegal for them to take a split
because they
on
have no
depreciation.
at-risk basis.
They
Whereas
have no
we have
at-risk
a
basis.
lot at risk. If Nicholas goes down, we owe the bank $23 million. Well,
If
23.
Nicholas the building, not if I go
Well,
down.
No, don't say that.
If I go down, I'm well insured. So we're going to say that a second time, because that's how wild this is. Our heads were spinning when we finally figured this out. We were talking to our CPA. We're like, why the heck don't any other syndicators do splits on depreciation? Why don't any other fund managers do splits on depreciation? They say, well, because they're not owners, they're employees. It's illegal for them to take depreciation. So it's only because Elaine and I have at-risk basis in the fund, and because we are owners and not employees, that we're allowed to take a split. Just try to wrap your brain around the insanity of that situation for a second. So we have so far to date deployed, a small portion of the capital, returned an outsized portion of that depreciation as a split to our investors. In general, Elaine and I try to take a certain amount of depreciation from the deal to offset, our tax basis, just like other investors in the fund. In some deals, we have returned 100% of depreciation to investors. In other deals, we've taken a split of depreciation, and it's definitely something that I would say we try to calibrate based on what sort of returns we're seeing on a depreciation basis for each specific deal.
Good question.
Yeah.
And then we'll end with these last 2 questions here, because baby Abram is getting hot.
Yeah.
So David asked, are there ongoing asset management fees? And the answer to that simple, nope. There's no asset management fees, not in the beginning, not in the middle, not at the end. There's no disposition fee when there's a sale. There's just no fees. So Income that could potentially be generated are if Nick represents us as a real estate agent, then he could potentially collect a commission.
Mhm.
If he doesn't,
And I do.
if he doesn't represent us, then he would not collect a commission.
Yep.
And then if our property management company manages it, then we could potentially collect a property management fee. But if our property management company doesn't manage it, then we
Yep.
would not. And if our property management company doesn't manage an asset, we would not collect an asset management fee.
Yep. And that makes sense for us because typically the job of an asset manager is to hold the property manager's feet to the fire, to be an oppositional party. So it actually costs us way less money to run our property management company for our fund than to run our property management company for like a different asset manager or for third party, property management for individual owners. We actually discount the cost of our property management services to the fund, as crazy as that sounds. So, our third party management clients pay more than our private equity fund pays, which I know sounds like the opposite of what we should be doing there. But just think about how easy it is. There's literally like 90% less overhead cost in the management of the fund owned assets, because if someone has a question like, oh crap, we need a roof on this house, like our director of operations on that wall over there says, hey Nick,
The
can we replace that
wall's
roof?
so thin, we
Is
just
it thin?
talk through it.
And I'm like, sounds good. Okay, now we have mitigated
Yeah.
the need for a 15-minute conversation with an investor and a emotional decision, because that one roof out of 100 need to be replaced this year. Well, on average, it's just fine. And then to be really transparent. So, how do you pay yourself, employees?
Yep. So that's the last question.
Yeah.
How do we pay ourselves and our employees without upfront fees? Are you really just working for free until capital is returned? That's our last question.
Yeah. So, I mean, we make money at this. We make the majority of the compensation is earned on the back end when we get the split, which is like I would say a higher than industry standard split, because there are no fees and there's no splits along the way. So we would rather get paid more at the end than get paid up front. And then we do collect, that property management fee, which tends to dial into about a break even for our property management company, but it does pay for a vast staff. So
Mhm.
we have a pretty large payroll. We've quadrupled our payroll here in the last 6 months. So when we go to do an acquisition, we load up the bus. We actually have a small passenger van, or a very large passenger van, and we will go storm the property with all the different property management staff that will ultimately manage that property, and they're able to look at that property with the lens that we want most from the people in the trenches. Well, that's theoretically a cost that, if I was a syndicator, that I needed to like fly out and pay a third party due diligence company. I mean, it's astronomically expensive to pay for these services on a fee basis. It's really cheap for us to borrow a couple hours of our staff's time to go do some due diligence. So you can see how there's an extraordinary amount of synergy by, basically running our property management company at cost and using that to offset our asset management costs, our real asset management costs. And then in terms of commissions, we do collect a commission. So, in our market, typically a 3% commission is customary. So on a typical single family home, we will collect, say, $9,000 of buyer commission on a $300,000 purchase. If we've purchased, 24 single family homes, that means that we've collected probably a couple $100,000 in commissions. On Nicholas, we were able to negotiate the broker splitting their commission 50-50 with us. We're not always able to do that. Commission splits are not as common in multifamily as they are in single family, and there's plenty of assets where we have not been able to successfully negotiate a commission, and so we have just not collected anything at the closing table on that deal, and we're okay with that. So Tanara Villa, we're going to collect nothing from that acquisition whatsoever. And we're totally okay with that, because we know we're going to get paid on the back end of the deal. So hopefully that gives you a little bit of insight, because to a certain extent maybe it does sound too good to be true or something like that, but there is just so much waste and inefficiency in what I would describe as the typical model, the non-vertically integrated model. You typically have like this fund manager persona that has like a investor relations specialist that they're paying to go talk to investors. They have an acquisition manager that they're paying to go find deals. They have an asset manager that they're paying to manage the property manager. All these people are flying all around the country all the time. The amount of largesse and waste that I see amongst many operations in the industry, like we'll go do due diligence with someone and they're like, okay, well, let's go to the cigar lounge and let's go to the nicest restaurant and stuff. And we're like, well, is the asset paying for that? Well, of course. And that's not how we roll. And so we're able to significantly discount these overheads because they just don't exist with our model. And that's all there is to it. Great question.
Yep, very good. Well, thank you so much, everyone, for coming. I'd love to hear your feedback. You can email either Nick or I, Nick at Black Swan Team or Elaine at Black Swan Team. So this is our first time that we've done an update like this. We intend to do these quarterly, kind of, Nick said our aspirations of kind of that Warren Buffett style quarterly update, and then we'll pepper those in with in-person updates annually. But we'd love to hear your feedback, what you liked, what you didn't like.
Is this too much?
Yep. We'd love to hear your feedback on the written versions. So we did a short kind of brochure if you just want a quick snapshot, or if you're looking at this, years from now and you just kind of want a quick memory of how things were performing now. And then we did a longer version as well. So we're just trying to share as much information as we possibly can, and would really appreciate your feedback if you had a moment to share anything with us. Next week, we have our Ask Me Anything. That one, we specifically are really going to target it away from talking about like our deals or offerings that we have, because we don't want that to just turn into kind of an infomercial. If there's occasional, questions here and there that make sense, but that one we really want to serve our community of, someone bringing a deal that they're putting together and asking how would we structure it, or what advice do we have, or just kind of an Ask Me Anything to serve our community. And then Fund 2 will be launching in the first week or two of June. So those are our updates. Anything you want to add as we end here?
I thought this was really good. Past outcomes do not necessarily indicate future results. I don't know if the future updates will be as fun as this one. Certainly this is the most exciting. It's our first update, but we really want to hear your feedback on if you like this and what you want to see more of or less of. Our goal is that 5 years from now we're doing an update once a quarter, and maybe one really big one once a year or something, of all of the funds and how all the funds are performing. And we've never heard of anything like that before, but that's kind of our vision for the future. And we hope it's just as fun for everyone on the call as it is for us.
And the baby slept, so he did his job.
Yeah, that's unlimited gratitude for that.
Good night, baby Abram. Good night, everyone. Thank you.
Thank you.